So a lot of the high-level problems that I've at least seen in traditional finance and DeFi is they're just very, very different. DeFi focuses on decentralization, and centralized finance or traditional finance focuses on a centralized point of power. There's things that both do really well. If you're looking at better AML and KYC, traditional finances are institutions that are observed by regulators and are very comfortable in reporting and showing this type of activity so they can allow more regulated money to come in. So if you look at like organizations like State Street, they have like 38 trillion in assets under custody. It's really excited by the growth of DeFi and Bitcoin, altcoins, various different things. It's been a massive, massive growth. It's grown at the same rate as the internet. But what it hasn't been able to do is officially allow a place for this money to move in and access the yields that they're getting in DeFi. Also, DeFi came up with something that was quite powerful. It was non-custodial digital assets. It empowers people to essentially bank themselves, to own their private keys and choose where they send them. So by integrating a better regulated bridge, it allows people to start banking themselves and access to traditional fiat, which ultimately affects the underbanked more than anyone else in the world.
Absolutely, and the interesting thing is this hasn't been done yet. And if we really want to focus on driving mass adoption of decentralized finance and technology, this is where the industry has to go. We have to focus on how we bridge, TradFi and DeFi as the preferred of this talk. Because ultimately, we want to make crypto products that are usable. We want to make products that are usable by people who have zero blockchain or zero crypto knowledge. If you look at the whole DeFi space at the moment, you look at even things like Solana, for example, 2 million active users. Relative to, say, the traditional sector, the opportunity in front of us now is huge. And there's a huge number of reasons why adoption has been slow. A lot of that is down to ignorance. A lot of that down is the speed of adoption being slow from traditional industries. But also a lot of that is down to the way in which people have been building products, which in a lot of instances have been built for a very technical audience. If we want to really continue to evolve the world of decentralization and Web3, we have to be able to put products in people's hands that they can use, that anybody can use. And I think one of the key questions I'd say to you, Brad, is why do you think there hasn't been enough focus on that today?
Well, I think a lot of the bridges that exist are really focused on servicing DeFi and monetizing as much as they can. So you have a lot of exchanges that are onboarding customers and kind of pushing it through an amalgamation of different rails to get back to fiat, taking spreads at every kind of different point. When you're looking at larger transactions, you really don't have that type of bridge that can handle, $1 billion, $2 billion plus transactions. You have to do OTC as kind of your only option there. I think also a lot of the focus has been, from DeFi's perspective, you've been naturally afraid that TradFi is going to negatively affect DeFi, and actuality, there's a good balance between. You can implement DAOs and decentralized governance and still bring in traditional finance and have KYC and AML activity, on onboarding and offboarding. Stablecoins are the best example of this. If you use a stablecoin, you can go through an existing regulated institution to mint that stablecoin, do KYC, do the logging of that activity, and then it goes to the wallet. And then the same as cash, once it hits the wallet, people can spend it, do with it as they will, and when they're ready to come out, they want to access fiat, they go back through that KYC and AML process. So I think that, when evaluating bridges, a lot of those two things haven't happened. A lot of people, on one side are looking to be more centralized, and the decentralized side is not really been super focused on working with the traditional finance side.
Excellent. And then what I think we're starting to see now, though, is that shift where more traditional, more significant capital pools are coming into DeFi. So from your perspective, in terms of the journey you've been on building this, who have you seen kind of coming into the space that's new, and what's attractive to the space for them particularly?
So from a TradFi perspective, I think State Street has done a really good job. They've just figured out their custody. They're using multi-party computation, which is a great solution. They're also really focusing on driving adoption of cryptocurrencies at an institutional level to allow real money flow into the DeFi space through their gateways. When looking at the DeFi space, I think, obviously what we're doing I'm really excited about. but also stablecoins in general, Terra, UST. They've done a lot of really amazing things. They started with decentralization and then they moved into core banking with oracleization of collateral, which if you're doing a collateral-backed stablecoin, transparency is key. So I think that there's a few spaces that are really moving. Obviously, you have the other stablecoins, which are, USDC, Paxos, which is Binance as well, and USDT, which have varying forms of transparency. Even USDC, you get attestations that are 2 months late. You don't really get to see real time what the underlying collateral is or what they're doing with it. You don't really get to participate in the upside of the governance. And then algorithmic stablecoins, in their attempt to be a bridge back to something stable, they often have to be over-collateralized, which is highly expensive and doesn't necessarily make sense from a capital efficiency standpoint. And then all the, where they are transparent, when there's an underlying crash in the market or a black swan event, the peg destabilizes and they can run into, a less than dollar stable dollar.
Awesome. And what do you think the current market for stablecoins is looking like? And to a large extent, what problem does Fluent solve and how is it a better bridge?
So the current market, I talked very high level to it, but there currently isn't a stablecoin that many regulated banks can participate in, particularly the larger ones, because the collateral requirements and they need to understand the type of composition of assets. They have very specific compositions that they can have. So, I was talking to Goldman Sachs recently. They can't even participate in Circle, even though they invested in it, because they use a percentage of the assets and they invest in different types of commercial paper, and that doesn't really fit within their regulatory scheme. And then, I think with the algorithmic stablecoins, they are trying to, they're making huge pushes to try to make a bridge, but still, again, with the over-collateralizations, it doesn't make sense. The counterparty risk for all these different participants, if you're a bank, the counterparty risk is far too high. You can't really trust your money deposited in another bank that is, unregulated in many cases. And even so, you can't really bridge that back to your assets under management, your deposits, and your customers. So I think one thing that we really focused on is we did a federation-based custody, so it's federated between multiple institutions. Underlying collateral is oracleized. They're based on the composition of assets that each bank holds. We assess an F score. That score essentially tells them over time how they're participating in the ecosystem, so that's fully transparent to all the actors, which builds a high level of trust for people to participate and also allows the banks to remain their assets under management and the deposits, collateral of the bank and their customers.
Awesome. So I suppose the one final topic then we should probably talk about is what we may think the future looks like. So I think for me, I think where I see the future now is that Web 2 effectively has ceased to be useful. It's hit capacity. And we've got this really interesting convergence between Web 3 technology, financial services, decentralization, and product. And when you look at the future now, you say, well, look, actually, we need to build products that go beyond regulation, beyond border, that are global, that are scalable, and start to address some real social problems within society. And I think if you look within the kind of DeFi crypto space generally, that is definitely the best use case. It's how you drive financial inclusion for people who don't have a bank account. It's how you enable somebody's wallet to be smart. It's how you enable people the opportunity to enjoy outsized incentives as well.